Let me be brutally honest with you. Bitcoin is dying, and the so-called experts at Galaxy Digital are finally admitting what bears have been screaming for years. Alex Thorne, the head of research at Galaxy, just dropped a bomb that should wake up every delusional Bitcoin maximalist out there. The price is sitting at a pathetic $78,000, down a catastrophic 37% from its all-time high. And guess what? It's going lower, much lower. This isn't a dip. This isn't a correction. This is the beginning of the end of the greatest speculative bubble in financial history. Galaxy Digital slashed their year-end target from a laughable $185,000 to $120,000. And even that feels optimistic when you look at what's actually happening on-chain. Technical indicators are screaming sell. On-chain data shows whales dumping 500,000 Bitcoin onto exchanges. Retail investors are capitulating. Institutions are rotating into gold and artificial intelligence stocks. The party is over, and everyone's rushing for the exits, except the bag holders who still think they're going to get rich from internet magic money. You want to know what's really happening? Bitcoin has entered what Galaxy calls the maturity era, which is just a fancy way of saying it's become boring, predictable, and institutionally dominated. The Wild West days of massive gains are dead. Volatility has collapsed because the same Wall Street institutions that Bitcoin was supposed to replace have taken over. Those spot ETFs that everyone celebrated, they're the death knell. Passive institutional flows mean Bitcoin now moves like a watered-down tech stock, except it has no earnings, no cash flow, no dividends, and no intrinsic value whatsoever. The technical picture is an absolute disaster. Bitcoin broke below its 365-day moving average at $102,000, a support level that held throughout the entire bull phase. When that broke, it triggered cascading liquidations that wiped out over $700 million in long positions in a single weekend. That's not strength. That's fragility. That's a leveraged casino built on nothing but hope and delusion. The RSI is at oversold levels, which the bulls will tell you means it's time to buy the dip. But let me tell you what it really means. It means there's still plenty of room to fall before we hit true capitulation. Let's talk about what Galaxy Digital conveniently isn't telling you. They mention whale distribution as a headwind, but they downplay the magnitude. 470,000 Bitcoin worth $50 billion got sold by large holders. That's not profit-taking. That's smart money getting out before the rug gets pulled. These whales aren't rotating into other crypto. They're going into gold, they're going into AI stocks, they're going into real assets with real value. Bitcoin failed to become the main trade in 2025, despite everything going for it. A pro-crypto president, regulatory clarity, institutional adoption, ETFs, everything the maximalists said would send it to the moon. Instead, it's bleeding out. The competition argument that Galaxy mentions is devastating when you actually think about it. Bitcoin is losing capital to gold and artificial intelligence. Gold, the asset Bitcoin was supposed to replace as digital gold, is absolutely crushing it. AI stocks are where the real innovation and wealth creation is happening. Stablecoins are eating Bitcoin's lunch in the payments narrative. Every single use case that Bitcoin evangelists claimed it would dominate has been taken over by better technologies or traditional assets. You're left with nothing but a speculative asset that goes up when there's liquidity and crashes when liquidity dries up. Here's what really grinds my gears. Galaxy Digital maintains a bullish long-term outlook while slashing near-term targets and warning about deeper pullbacks. That's the classic Wall Street two-step. Talk bullish to keep retail buying, while institutional clients get the real advice behind closed doors. Alex Thorne says 250,000 by 2027 is still plausible. Plausible? Based on what? The same models that predicted 185,000 by now? The same on-chain analysis that completely missed this collapse? The same institutional adoption narrative that resulted in ETF outflows instead of inflows, the leverage situation is catastrophic. Over the weekend, with thin liquidity and institutions away from their desks, Bitcoin briefly touched 74,000 before bouncing back. That's a $10,000 move in hours, based purely on leverage flushes and stop-loss cascades. This is not an asset class. This is a derivatives casino where market makers can manipulate prices at will because there's no real depth. Galaxy notes that market depth remains thin relative to earlier in the cycle. Translation: it takes less money to move the price down than ever before because real buyers have disappeared. Let me destroy the HODL narrative while we're at it. 1 in 3 Bitcoin holders is now underwater, according to CryptoQuant. These are the people who bought into the hype, who dollar cost averaged all the way up, who believed the influencers telling them Bitcoin only goes up. Now they're sitting on losses, hoping for a recovery that might never come. The data shows these levels historically marked local bottoms, but history doesn't repeat, it rhymes. And the rhyme this time might be a multi-year bear market that crushes the spirit of an entire generation of retail investors. The macro environment couldn't be worse for Bitcoin. The Federal Reserve is playing wait and see with rate cuts. Strong jobs data delays easing. Weak GDP could trigger cuts, but also signals recession, which historically destroys risk assets like Bitcoin. You can't win. Bitcoin's correlation with equities has gone through the roof, meaning it's just a leveraged NASDAQ trade now. When stocks crash, Bitcoin crashes harder. When there's a flight to safety, Bitcoin gets obliterated. The safe haven narrative is completely dead. Gold is trading at $4,700 an ounce, proving what real safe haven demand looks like while Bitcoin bleeds. Galaxy Digital talks about the Trump administration being pro-crypto, as if that matters. Paul Atkins at the SEC, the Genius Act, regulatory clarity. None of it stopped Bitcoin from dropping 37%. You know why? Because regulations don't create demand. Clear rules don't make a worthless asset valuable. The Clarity Act might pass the Senate or might stall in committee. And either way, Bitcoin's price will be determined by liquidity conditions and whether there are actual buyers, not by whether some politicians in Washington decide to be friendly. Here's the ugly truth that nobody in crypto wants to admit. Bitcoin's dominance as a percentage of total crypto market cap has been eroding. Retail attention is fragmented across thousands of altcoins, meme coins, and DeFi protocols. Institutional money is rotating into regulated products and away from spot Bitcoin exposure. The stablecoin market has exploded while Bitcoin stagnates, proving that crypto adoption is happening, but not in the way Bitcoin maximalists predicted. People want programmable money and decentralized finance, not a slow, expensive, energy-intensive digital rock that can't scale and has zero use cases beyond speculation. The energy consumption narrative continues to haunt Bitcoin. As the network hash rate stays near all-time highs while price collapses, miners are getting squeezed. Bitmain is slashing miner prices to fire sale levels because demand has evaporated. $3 per terahash for S19 models, down from double-digit figures just months ago. Mining profitability is cratering. When miners start capitulating and turning off machines, the security of the network becomes questionable. The death spiral scenario where price drops lead to miner capitulation, leads to reduced security, leads to further price drops, becomes a real possibility. Let's address the elephant in the room. Prediction markets completely missed this crash. Polymarket contracts tied to Bitcoin hitting higher price targets softened gradually, but never implied the kind of abrupt volatility that actually occurred. Why? Because prediction markets optimize for end states, not paths. Traders can ignore short-term crashes if they believe in eventual recovery. But here's the problem. The crash itself changes the fundamentals. Forced liquidations create selling pressure. Sentiment shifts from greed to fear. Momentum evaporates. What prediction markets missed is that Bitcoin's fragility means small moves can become big moves very quickly. Galaxy's research on prediction markets reveals their structural limitations. Compressing complex beliefs into binary outcomes overstates consensus and obscures tail risk. The same applies to Bitcoin price predictions. When everyone's model assumes institutional adoption drives prices higher, nobody's prepared for institutional redemptions driving prices lower. The AI price prediction models are split. Claude suggests 82,500. ChatGPT says 75,000. Gemini predicts 72,500. The average is 76,667, essentially flat from here. Not exactly the rocket ship to six figures everyone was promised. The technical indicators paint an even bleaker picture. The 50-day moving average is falling and acting as resistance. The 200-day moving average has been declining since January, showing long-term weakness. Every rally gets sold. Every dip finds fewer buyers. The market structure has fundamentally changed from accumulation to distribution. Smart money is exiting. Retail is left holding the bag, wondering why their Bitcoin isn't going up when all the news seems positive. You want to know why Bitcoin isn't recovering despite all the supposedly bullish developments? Because the developments aren't actually bullish. ETF flows have been negative. Vanguard opening access to 50 million clients sounds great until you realize those clients aren't buying. BlackRock's IBIT has $71 billion in assets, but that represents capital that came in at much higher prices. Those holders are underwater, and there's no new money coming in to bail them out. The standing institutional bid that Galaxy keeps talking about only matters if institutions are actually bidding, and the outflow data proves they're not. Here's what I think is really happening. The smart money saw the writing on the wall months ago. The October crash that liquidated $19 billion from the crypto market wasn't random. It was a coordinated exit. Whales transferred over 400,000 Bitcoin to exchanges and institutional buyers, which sounds like selling to me. The maturity era that Galaxy describes is just code for the end of the growth phase. Mature markets don't deliver life-changing returns. They deliver low single-digit annual returns if you're lucky, and Bitcoin can't survive as a low-volatility, low-return asset because the entire value proposition was always based on asymmetric upside. The comparison to the dot-com bubble becomes more apt every day. In 2000, everyone knew the internet was the future, but that didn't stop 90% of internet companies from going to zero. Bitcoin might survive long-term as a niche speculative asset, but that doesn't mean current prices are justified or that holders will see returns. Most participants will lose money. Some will lose everything. The winners will be the early adopters who already cashed out and the exchanges collecting fees on every desperate trade. Let's talk about what comes next, because Galaxy's warning about deeper pullbacks should terrify anyone still holding. The next support level below 75,000 is in the mid-60s. After that, it's the low 50s, where the 2025 lows were. A full retracement to the previous cycle high, around 69,000, is entirely possible. Some bears are calling for a crash back to the 30s or 40s. At some point during this decline, even the most stubborn holders will capitulate, and that's when we'll see true price discovery. The sad reality is that Bitcoin had its moment, and it's over. The 2020 to 2021 bull run was peak retail mania. The 2024 to 2025 run was institutions testing the waters and deciding it wasn't worth it. Now we're in the slow bleed phase, where hope gradually dies and people start accepting that maybe, just maybe, Bitcoin isn't the future of money, or digital gold, or an inflation hedge, or anything else its advocates claimed. Maybe it's just a speculative asset that had its run and is now reverting to its intrinsic value, which happens to be zero. Galaxy Digital can maintain their long-term bullish stance all they want. They have to because they're deeply invested and their business model depends on crypto remaining relevant. But their actions speak louder than words. Slashing price targets by 35%, warning about mounting technical weakness, highlighting on-chain signals pointing to further downside. These aren't the words of true believers. These are the words of realists, trying to manage client expectations before the real pain begins. The Bitcoin dream promised financial sovereignty, wealth redistribution from traditional institutions to regular people, protection against government overreach and inflation. Instead, we got a speculative casino dominated by the same Wall Street firms and hedge funds that Bitcoin was supposed to disrupt. We got an asset so volatile and risky that no sane person would use it as actual currency. We got an energy-intensive system that can process 7 transactions per second, while Visa handles thousands. We got broken promises, shattered dreams, and now, finally, we're getting the price correction that fundamentals always demanded. So when Galaxy Digital's head of research flags the risk of deeper pullbacks, believe him. When technical indicators scream oversold, remember that things can get a lot more oversold before they bounce. When on-chain data shows whales distributing, understand that they know something retail doesn't. The writing is on the wall for anyone willing to read it. Bitcoin's weakness points lower because there's no fundamental reason for it to point higher. The bull case is exhausted, the bears are circling, and the crash that everyone swore could never happen is happening right before our eyes.